A really important concept in CVP analysis is the contribution margin. And the reason why it's important is because it's the profit made on each sale, or on the sale of each unit, which we're going to call gross profit later in the course, but for now we'll just say it's the profit on each unit. And it's calculated by taking the selling price of each unit, so whatever product it is we're selling, and taking away the variable cost, which we looked at in the previous video. So to use an example, Mike's bikes, we had the following costs to make each bike. They were called variable costs. We had the metal frame, we had the tires, we had the gears, and then that was it. So the total variable cost was $300 per bike. Mike decides to sell each bike for $800. So his contribution margin per unit is the selling price, or $800, minus the variable cost of $300. That bike is contributing a profit of $500. Every time we sell a bike, we make a profit or a contribution margin of $500. So what does that actually mean though? Well, it's a good way to say contributing profit, or covering, I guess, is a good word. We can say the business has some fixed costs every month that it needs to cover regardless of how many units it produces or sells. So there's our costs again. We looked at those three there, the rent, the utilities, the wages. That came to $6,000. We've got to cover those every month, no matter how many bikes we sell. So one way we can think of that is to say, well, we've got this big block of fixed costs here of $6,000 to cover every month. Every time we sell a unit, it's going to cover or contribute $500 profit towards covering those costs. So if we sell one unit, it's going to contribute $500. We sell another one, that's going to contribute another $500, and another one, and it's going to, every time we sell one, it's going to cover a little bit more of these fixed costs. And eventually, if we sell enough, we're going to cover all of our fixed costs. So the contribution margin will be the amount that each unit contributes to covering those fixed costs. That's going to be what's called our break-even point, and we'll look at how to calculate that next.